Okay, so sorry for the delay in posting this, but like I said, I will give you guys an extra day or two to work on the exam if you need to. So anyway, what this basically is a final exam review where I've basically taken many, not all, but many of the question types that are on the final and didn't really change the wording too much, only really changed numbers around. So it'll give you a very good idea on at least those question types that I go over here, exactly how and to do the problems that the final will ask you to do and why to do them that way. So I'm also posting, in addition to this video, a blank final exam review template. So you know, you might want to work through the problems on the template first by yourself and then compare those to what I have down and see what the differences are. So first of all, question number one, and again I'm doing this in Excel. I like to, as an accountant, work in Excel. It's just more convenient for me. Obviously you don't have to do that. I wouldn't say, you know, if you are going into accounting, I would say that is probably smart to start working in Excel. But in general, obviously this is just a method of convenience for me. So we'll start with question one. Corporation declares a cash dividend of $2,225,000. What is the correct journal entry as of the declaration date? So remember, for dividends, as far as recording transactions, the declaration date and the payment date are the two important dates. And on the declaration date, the company is basically obligating themselves to pay the dividends in the future. So what that would look like, I would have my debit entry, and that would be for cash dividends, and then the amount. Then I'd have my credit entry, dividends payable, and then the amount. Okay, so that one's pretty straightforward. It's basically just incurring a liability that I say I'm going to pay my stockholders that amount in the future. So moving on to number two, assume that Antler Corporation purchases a 10% $500,000 bond for $510,000 on June 30th, 2012 that pays interest semi-annually on July 1st and January 1st. What is the correct journal entry to record the initial interest payment on July 1st, 2012? So this is basically the day after they purchase the bonds. They're entitled to receive an interest payment that first day. And remember, again, when you're looking at bonds, it doesn't matter what we paid for them right here. It matters what the value, the face value of the bonds are when determining the interest that you're going to receive. So we look at the $500,000. We see that it's a 10% bond. So that means 10% or $50,000 will be payable in interest every year. Since it pays semi-annually, we're going to divide that in half, and you will see receipt of cash, $25,000, credit, interest revenue, $25,000. Okay, and again, it's important to realize and distinguish between whether the company we're talking about has purchased the bond or whether the company has sold the bond. From the purchaser's point of view, this is the correct journal entry. From the seller's point of view, obviously the seller is not receiving cash, so this would not be the correct entry from the seller's point of view. So remember to always pay attention to which point of view you're actually being asked about. Okay, number three, partners T, G, and Y are forming a partnership. They each make the following contributions. So we've got, for partner T, $15,000 cash, equipment with a book value of $5,000, fair market value of $10,000. Partner G is just giving cash of $20,000, and partner Y giving accounts receivable with agreed upon value of $25,000. Okay, so the question just asks for partner T's contribution, and again, we're looking at this from the perspective of the partnership. So we're interested on the partnership's books to see what it looks like when T makes these contributions. So we've got debit of cash, $15,000. We also have a debit of equipment, and the only real trick to this question at all is whether you're going to use $5,000 as the book value or $10,000 the fair market value. Remember, when you're contributing to a partnership, the partnership doesn't really care the value of it on your books. They care about what it's worth to the partnership. So we're going to always look at fair market value here. This is just thrown in here to kind of throw you off. So fair market value of $10,000. So we will list that on our books as the partnership, $10,000. And the credit entry here will be partner T capital, showing $25,000 going into partner T's capital account. Okay, so that's how you do that one. Number 4, D Corporation declared a 10% stock dividend on its 500,000 shares of common stock outstanding. Stock has a fair market value of $200 per share and a par value of $100 per share. The correct entry was already made on the declaration date. What is the correct entry for the payment date? Okay, so first, let's look at what it would have been on the declaration date. Okay, so when you're figuring, and the reason we're doing this is because it makes it easier to then look at, on the payment date, what's left over. So we look at shares outstanding, it's 500,000. 10% stock dividend means that we're paying to our current shareholders. We're going to give our current shareholders a total of 10% of what's outstanding. So we're going to give 50,000 shares of common stock to our shareholders. Okay, and so when we declare, whoops, let's put the debit in there, stock dividends, and when we declare the dividend, we are looking at the fair market value. So what's the current, what would be the current cash value of 50,000 shares of common stock? So since they're selling right now for $200 a share, 50,000 times 200 is 10 million, I believe. Let's see. Yeah. Okay, so that's the stock dividends. Then we have common stock dividends distributable, and we have paid in capital in excess of par. Okay, so under common stock dividends distributable, we are going to look at the par value of the stock instead of the fair market value. So if you look at the difference here, we got $100 par value, $200 fair market value. So this is going to be half as much, oops, or 5 million. And the difference between those two is the additional paid in capital, which will also be 5 million. So again, this is not the right answer for this question, but this is the correct entry that was already made. Okay, so the reason we did that is because on the payment date, we want to know what there is left to do. And basically all we're going to do on the payment date is this entry here on the distribution date is kind of like a liability account. It's not an actual liability account, but it kind of functions that way. So what we're going to do on the payment date is we're going to zero out this stock dividends distributable, and the way we're going to do that is to make a debit entry over here instead of the credit entry that's right here. So we'll have a debit to common stock dividends distributable, 5 million, and credit common stock 5 million. Okay, so this right here, I'll put it in, whoops, put it in red. That's the right answer for this question. And I basically did the whole thing just to show you that the amount that's different between the fair market value and the par value is basically all taken care of with this first entry. And all that we're left here on the second entry, we're looking at the par value. And we're zeroing out the common stock dividends distributable and showing that common stock has gone down by $5 million. Okay, so next question is basically going to show us, I was going to ask for this first part. When a stock dividend is declared, the entry that we're going to look at. So the question, corporation, excuse me, Corporation X declares a stock dividend of 25% on its million shares of common stock outstanding. The stock has a par value of $20 per share and a fair market value of $25 per share. What is the correct entry to make as of the declaration date? So again, we're going to look at the shares outstanding, which is a million, and we're going to distribute 25% of that 1 million out, and we're going to push that out to the current shareholders. So 25% of a million is 250,000 shares. Okay, and again, if we look at this as kind of a template to what we're doing down here, first entry is going to be stock dividends. Scoot this up a little bit. And that is going to show us the fair market value. So we're going to basically have, and I'm going to use an equation here just so I don't give you the wrong number. We have 250,000 shares times $25 per share. And that gives us, let's change that to no, that doesn't really help. I'm going to change this to accounting format here, even though generally you don't put a dollar sign with journal entries, but this will just show you where all the commas are, more easily readable, so you can see that's $6,250,000. Okay, whoops, didn't mean to do that. Okay, so then our next entry following this same template up here is going to be common stock dividends distributable, and that is going to be 250,000 shares times $20 a share, or $5 million, which you can see there. Okay, and then our last entry, paid in capital in excess of par, just going to be the difference between those two. So the difference between fair market value and par value, and we can see just by looking at that, whoops, that it's $1,250,000. Okay, and again, if I was going to go through and look at the payment date, I would follow this format here, and it would only be the par value that I was concerned with and filling out the rest of that journal entry. Okay, number 6, if Corporation DT sells 10,000 shares of common stock with a par value of $100 per share for $75 per share, and Corporation DT has a balance of $200,000 in its paid-in capital in excess of par account, what is the correct journal entry to record the transaction? So what we're looking at here is we're selling 10,000 shares of stock for less than par value. Okay, so let's start out with the first part of this entry because that's pretty self-explanatory. We're selling stock, and what we're getting in exchange is cash. Okay, so we're getting 10,000 shares times $75, or $750,000 in cash. And then, skip down to this one, we have, excuse me, common stock is going to be just, remember when we buy, or I'm sorry, when we sell stock, the common stock account will just show the par value of that stock. So again, we'll have 10,000 shares times par value of $100 per share, and that gives us 1 million. And you see I skipped the line here because I knew that the debit side was going to be less than the credit side. So I know I need another debit entry here to at least one more debit entry here to make the debit side equal the credit side. Okay, so first step is I figure out what the difference is between these two. So that's $250,000. That's what I need to make up here. So, whoops, that's not cash. First thing I do is I look at my paid-in capital in excess of par account, and whatever's left in there, and here we see in the question that there's $200,000 in there, I can use all of that to kind of cancel out this less than par value sale that I'm making. But you'll see if you add these two together that I'm still short $50,000 here. So I'm actually going to need another debit entry to make up the difference. And that will come from retained earnings. Okay, so that will be another 50,000, and there you go. Okay, so when selling stock, when a company is selling stock for less than par value, you figure out the difference between what they sold it for, what the par value was, and then you try to make up that difference by first exhausting any amount of money that's in the paid-in capital account. If this number here had been $300,000, then I could have used the entire $250,000 difference. That could have all come out of paid-in capital in excess of par, and I wouldn't have to take anything out of retained earnings. Okay? Or if there had been zero balance in this account, I would have had to take all $250,000 out of retained earnings. So basically it's kind of like an order of operations here. When there's a difference and you're selling for less than par value, take everything you can out of paid-in capital in excess of par, and whatever still needs to be taken out to balance the equation or the journal entry has to come out of retained earnings. Okay, moving on. We have number 7. Stock Goggle cost $50,000 to purchase and is now worth $35,000 as of the last day of your company's fiscal year. What is the correct journal entry to record the decline in value of the stock? So again, what we're asking here is we're not selling this stock. We bought it and we're holding it as of right now, and the fiscal year is ending. So we have to basically what in accounting they call market. We have to mark the stock to market price, so that our balance sheet and basically our financial statements will reflect the decline in value that has happened for this stock over this time. And as you'll see right here, before I even started the question, I had already pre-written out these account names. And the reason I did that, well, to be honest, the reason I did it is because I always forget what these account names are. And the reason I'm telling you that is because in accounting, I know a lot of beginning accounting students get really concerned about memorizing these account names. And I'm telling you this because I don't really think that that's that important. And even as someone who has held high-level accounting and finance positions in the past and has years of experience doing this stuff and is a CPA and a professor of accounting, I still don't remember all the account names. So you shouldn't feel bad as a student at this stage of your accounting career, even if this is the last stage of your accounting career. You shouldn't feel bad if you don't have all these memorized. Okay? So basically what we're doing here, since I already have the account names down, is I just need to fill in the amount. So I just take the cost of the stock and subtract the current value, and that shows me how much I need to adjust it. And in this case, it's going to be for $15,000, and I just plug that in here. Okay, and what these accounts mean is basically this is showing me that the unrealized loss from this stock will show up on my income statement, which is important if you're looking at certain ratios that are important to investors when they look at income statement. it's important to note which transactions have an effect on the income statement. And then right here, this account, market adjustment trading, just shows me that this is a trading security. Stocks are generally always considered trading securities because they're very easily tradable and often not kept as a long-term investment. So that's just to distinguish that from, say, something like a bond that is more likely that you're going to keep for over a year. Okay, number 8. Dart Corporation issued $2 million worth of 10% 5-year bonds at a rate of 99. At the end of their 5-year maturity, what is the correct entry for Dart Corporation to make to show that the bond principal is being paid? So, again, some of this information is on here basically just to kind of try to trip you up. All you really need to look at here is what the initial face value of the bonds are. That's $2 million. So when you sell $2 million worth of bonds, regardless of what you sell it for price-wise, at the end of the maturity of those bonds, what you're going to owe the bondholder as the principal amount is the face value of the bond. Okay, so when you first sold these bonds, you recorded a long-term liability for $2 million. And what we're doing now is basically just canceling out that long-term liability and showing that cash has gone down that same amount to pay for it. So when I first sold the bonds, I would have recorded a credit to bonds payable for $2 million, and when the bonds come to maturity and I have to pay the principal off, I will eliminate that liability, which is what this entry here does, and I will show that my cash has gone down by $2 million. So pretty straightforward. Just remember that when you're looking at maturity of a bond, you're always looking at the face value. Doesn't matter what they paid for it. Okay, question 9. Assume that you own a service-based company and your company has already provided a service worth $500,000 to an individual. You've invoiced the individual, but you have not yet paid that invoice. What is the correct adjusting entry, journal entry, to show this money has been earned but not received? Okay, so money that has been earned but not received is going to show up on your accounts receivable. Okay, and in this case, since the service was a $500,000 service, we're going to mark that down and we're going to credit service revenue because revenue is shown when it is earned. Okay, so we've earned this revenue, we've billed for it, so we have an account receivable, and now we're just waiting to get paid the money that this other individual owes us. So pretty straightforward there. Okay, this is the last question on here. Again, these are not all the question types that you'll see on the exam, but these are a lot of them. Okay, so I'm not saying that you should only review this material, but reviewing this material that I'm showing right now will, if you review it carefully, it should guarantee that you at least get these question types right, and then maybe you'll have to do a little bit of research back into what we already studied, or if you remember it, that's fine, to get the rest of them right. Okay, question 10. From seller's perspective, and again, since sellers is highlighted there in all caps, that's going to be important here. Assume that you sell $50,000 worth of goods to another company. Your cost of goods sold on the transaction was $30,000. You already recorded the sale, but have not yet received payment. Okay, so you recorded this as an account receivable. Before you receive payment, the other company returns 50% of the goods. What is the necessary transaction to, or I should say, what is the necessary journal entry to record the transaction of the return of these goods? Okay, so first thing to remember here is that when you are selling something, there's basically going to be two sets of debits and credits. First, you're going to have debits and credits that show what you're selling it to this customer for, and then you're also going to have a set of debits and credits that show an increase or decrease of inventory and cost of goods sold going up. Okay, and so when we receive a return, we've got to show both of those categories of journal entries kind of being reversed. Okay, so first of all, let's look at the debit and credit that we would have recorded for the amount that we're selling these goods to the other company for. Okay, so we're going to have a special account that will be kind of sort of like an expense account, but it's going to be allowance for returns, and that is going to be for the amount here. Again, since they're returning 50% of the goods, we sold 50,000, so 50% of that is going to be 25,000. And then we're going to have a credit to accounts receivable for 25,000. Okay, so that right there, the credit to accounts receivable reduces the amount we're expecting to collect from this company by 50% because they returned half the goods. And then this account here will be netted together on the financial statements with the revenue accounts to show what the net revenue is that we earned from this transaction. So that will effectually reduce the amount of revenue we earned by that same amount. Okay, but then we still have the question of how did this affect, how did this affect our cost of goods sold and our inventory? Okay, so it affected our inventory by giving us back 50% of this inventory that we got rid of. Okay, so since the cost of goods sold on the transaction was $30,000, that means we have $15,000 worth of inventory coming back to us, and our cost of goods sold is being reduced by $15,000. Okay, so that's the format of the entry. Remember that the top part of this entry is going to reflect essentially the retail price that the customer paid for it, and the bottom part of the entry is going to reflect how much it cost us to produce, which is how it is reflected here in inventory and cost of goods sold. Okay, so that's the end of the review. Pretty straightforward, and I wish you the best of luck on the exam. I know it's been kind of a weird class because there's only 2 people in it. It's actually my first time teaching online classes, so I appreciate the patience that you've shown with me, and I hope that you all have the best of luck in the future. And remember to come and talk to me if there's anything I can do to help you, or shoot me an email, and I would be glad to do it.